On the SBS On the Money podcast, Trump versus Powell, as the US Federal Reserve leaves interest rates unchanged. Australia's unemployment rate too unchanged, but the iron ore price tumbling. All of that and more next. Hi everyone, it is Thursday, the 19th of June 2025. The Australian share market today not doing much. The S&P ASX 200 down. Jim Clark from TMS Capital soon, and find out why investors are sitting on their hands despite all this volatility around the world. But first to the US, where the Federal Reserve left interest rates on hold there at 4.25% to 4.5%. And that's despite increasing pressure from Donald Trump for Fed Chair Jerome Powell to cut interest rates. Even ahead of the decision, President Trump called Jerome Powell stupid for leaving interest rates on hold for months, as some of the other major central banks around the world continue to cut rates. To find out more, along with details about today's unemployment rate, I spoke with Pat Bustamante, economist at Westpac. Pat, can we start with the US economy? Rates on hold there. That's despite Donald Trump continuing to pressure Jerome Powell to lower interest rates, even calling him stupid ahead of the decision for holding rates for such a long time, because I think interest rates in the US hasn't fallen since Trump took office. Why do you think, first of all, this pause?
That's right, and you're right, the president didn't mix his words there. So from what the FOMC's communication this morning, it was all about the strength of the domestic economy. So domestic activity still remains quite strong in the US, despite that small fall in the March quarter. If you look at underlying private demand in particular, that remains quite strong. And the labour market is not crying out for a rate cut, similar to the conditions in Australia. And when you put that together, I guess one of the key uncertainties is how the increase in tariffs are going to affect activity going forward. But I guess that's uncertain. But where it is more certain is that the higher tariffs are going to have to be paid by someone, and that's likely to be the US consumer, and that's going to have an impact on inflation. So he's taken a wait and see approach. He's got the scope to take that approach, given that the domestic economy remains resilient and the labour market remains resilient, even though some of the soft indicators like confidence, there was a non-farm payrolls read for May, which was quite soft. So there's some indicators that things may slow further. But at this point in time, the economy is holding up, so it gives them the chance to wait and see how the tariffs will feed through to inflation.
So Jerome Powell's term ends in May next year. Will Donald Trump likely appoint someone who will bow to his pressure? And what do you think that would mean for the path of US interest rates? Or is it still too far away to think about?
I would say it's a bit, it's very uncertain, still a bit too far away to think about. I guess the only, risk or red flag there for the US president, if he did want to go down that path, is that markets don't like uncertainty, markets don't like risk, and they price financial assets accordingly. And we know the president takes account of how markets react to announcements and respond. We saw that when bond yields in the US started to increase, and that kind of led to pauses and in terms of trade policies. So we know that the president takes account of how markets react, and we know that markets don't like uncertainty. So that could be a bit of a pause button for him in terms of who to appoint next. But as I said, it's a bit uncertain at the moment. It's still far away. There's a lot to happen this year. We're just treating that as a bit uncertain at the moment.
Okay, if we focus on the Australian economy, labour force data out today, employment down 2.5%, yeah. The unemployment rate remaining at 4.1%. What does this say about the jobs market?
So when you look at the monthly outcome, it was a bit mixed. As you say, employment fell by 2,500 individuals in the month of May. So that was a downside. But you also look at hours worked, for instance, and that increased 1.3% in the month of May. So it was quite strong. And on the back of that increase, you saw the underemployment rate. So those people that want more hours, that also ticked down by 0.1 of a percentage point. So it was a bit of a mixed bag when it comes to the labour force survey. But if you take a step back and you look at how the labour market has been performing over the last 6 to 12 months, it's been unambiguously quite resilient. So we know, for example, over the last 3 months, if you take the average employment growth, it's been about 37 on average per month. To keep the unemployment rate steady, you need about 30,000 new employment gains each month, given our population growth. So that's been actually, we've been achieving employment growth of over and above that minimum required to keep the unemployment rate steady. You look at things like the employment to population ratio, that's remained above 64%, close to a record high, and that's a very kind of powerful indicator when it comes to the labour market tightness. And hours worked, that was quite soft late 2023 into 2024, but now that's started to rebound. When we saw hours worked increase 1.3% in the month and 3.1% over the year. So that's been quite a strong kind of rebound in yearly terms as well. And that suggests that the labour market is quite resilient and isn't falling off a cliff or isn't crying out for rate cuts, as Jay Powell put it this morning in the Australian context. So it was a mixed month, but like when you take a step back, the labour market remains quite resilient.
What about future indicators, though? What are they pointing to? And are there any signs that businesses are feeling nervous amid economic uncertainty? Because anecdotally, we're hearing and seeing a number of especially white-collar jobs going.
Yeah, but I guess this has been the conundrum the Reserve Bank has been in for the last, say, 6 to 12 months. So on the one hand, we're seeing activity, particularly in the private sector, very weak. So we got the March quarter national accounts a few weeks ago. That was 0.2 for the quarter, very weak outcome. So that, I think some of the forward indicators, so you're right, some of the indicators when you look at things like confidence, both on the consumer and business side, that took a big hit following Liberation Day, but now that's kind of retraced a bit. So it's kind of recovered a bit from that initial fall. So some of the indicators, you could make a case that, yeah, maybe there'll be a bit of a slowdown, a further slowdown going forward. But that's kind of where we've been for the last 6 to 12 months. So activity has been quite weak, particularly in the private sector. But I guess for the Reserve Bank, what they're concerned about is cost pressures in the economy, and that remains elevated. And one of the reasons that remains elevated is because the labour market remains resilient. More people who want jobs are finding jobs. That's feeding through into aggregate productivity numbers, which are quite subdued or quite dire. If you look at the aggregate numbers at the sector level, it's a bit more mixed. So that's putting upward pressure on cost. And I guess what the Reserve Bank is concerned about is if they, loosen policy, you could have a stalling in the disinflation process. So that's a conundrum that the Reserve Bank kind of faces. I think that conundrum or that contrast is only getting bigger now, given the uncertainty driven by the tariffs. But it's still, it's still the issue or the trade-off which the Reserve Bank faces. And that's why we think that the Reserve Bank will wait to August to cut. When it has a full inflation picture, it's got the quarterly inflation release, which includes the update of the entire basket of all goods and services consumed by households. And at that point, we think they'll have enough confidence to suggest that, the weakness in the real economy is probably outweighing that cost pressure where we're seeing through, labour costs.
It's Pat Bustamante there from Westpac. Now, Market Day on the SBS On The Money podcast. Well, the Australian share market didn't do much today. By the close, the S&P ASX 200 fell 0.09%, 8,523. For the details, I spoke with Ben Clark, portfolio manager at TMS Capital. Ben, what's driving the market today? Is it US rates, Aussie jobs, trade tensions, or geopolitical risks?
Yeah, look, it's a weird time on the market at the moment. We've got complete chaos playing out on the global front. There's all sorts of reasons you could think for the market to be wildly up or down, but it's completely flat. And we've also had very little volatility during the day today. So, Investors are sitting on their hands. We do have a public holiday tonight in America, and typically we do see low turnover on our market leading into that. But broadly, investors are saying these worries and these issues that we're seeing are going to blow over relatively quickly.
There are lots of little things we could talk about. I know that the Commonwealth Bank, for example, today hit an intraday record, but we're also seeing iron ore continuing to tumble, right? Below 93 US a tonne on those Singapore prices, down from 100 just a month ago. What's going on here, and how is this being reflected in markets?
Yeah, look, it's continuing to see the resource part of our market out of favour, which has been the case for a couple of years now. The banks have been everyone's been talking about for 18 months or so. Resources, I think, have been used to fund that. And at the moment, with the iron ore market, we're going through a period which cyclically is weak. We normally get a restocking event happen in a month or two. But I think the big thing is the market's continually expected the CCP to launch a major stimulus package to get the Chinese economy going, and they've continued to sit on their hands and push back. And I think the faith is starting to dissipate that this is actually going to happen, and that you will see that big bounce in resource stocks.
Any other company news you're keeping an eye on today?
Company news is quiet. If you own a company at the moment, you don't want any news. This is a dangerous period for investors. The worst thing that you could see at the moment is an announcement saying trading update. We're getting very close to the blackout period. So that's the period where most companies will be well aware of their financial results. If they haven't said anything to the market, they're probably going to hit guidance. And it's around another week or two that they will tell the market if they're not going to hit it. Then we go into a typically quiet period, and then the gates open and we have reporting season in August. So not a lot of company news, which is hopefully a good sign for the forward reporting season.
And so at the moment, what are you telling your clients at the moment, and are there any opportunities for them?
Yeah, look, to me, very rapidly, our local market seems expensive again. This August reporting season, unfortunately, is going to be another one where, based on consensus forecasts, we are going to see negative earnings growth for the financial year that we're just lapping at the moment. And yet we're seeing a lot of Australian blue chip stocks trading at all-time highs. And so, what has happened is multiple expansion. Investors are paying higher profit multiples for the same profit or slightly lower profit. So for things to really make sense, we need to start to see some profit growth on this local market. It looks expensive, so what our advice is: have a bit more cash, trim some money, and going into that more volatile August reporting season, be able to take advantage of opportunities.
Ben Clark there from TMS Capital talking about the markets. Hey, don't forget, if you do enjoy the podcast, do us a favor and give it a like and a review on Apple Podcasts and Spotify, and don't forget to subscribe.
This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice, and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.